Dr. White, for more than 80 years, shareholders' engagement has been focused on a company's strategic direction, or perhaps their long-term goals would be a better way of putting it, with an eye on maximizing revenue and increased returns for investors. Recently, there has been an increase in the number of shareholder proposals that have turned boardrooms into partisan battlegrounds, fighting over social agendas instead of focusing on sound financial management and business strategy. Could you please provide insights into the recent trends of politically motivated shareholder proposals, specifically how this shift has changed the focus of corporate boards away from investors and company strength and onto external agendas untethered from the organization's financial health?
Thank you, Chairwoman Wagner, for that question. Yeah, I would agree that there's been a politicization in the corporate boardroom. Companies now have to misallocate what are scarce resources that investors provide them in hopes of generating a return. And they are focused not necessarily on the G component of ESG, but more on the environmental and social component. As Ms. Minow pointed out, oftentimes there are shareholder proposals to remove managerial entrenchment mechanisms such as a supermajority vote. Just want to remind everyone that's the G component of ESG, which academic research has shown for more than 20 years is valuable. The environmental and social concerns are that if you have a shareholder or a subset of shareholders or a minority shareholder that wants to push a special interest, they may be willing to sacrifice investment returns if it forwards their mission objective. That does not benefit all investors. In fact, if businesses do not run their organizations in the most efficient way, their competition will, and we compete on a global basis. So to the extent that we politicize the boardroom, then these burdens are just going to be passed on to public companies, and they may actually go private. That is what the research shows.
Great, Mr. Nettram. In November 2021, the SEC issued new guidance that made it difficult for companies to exclude ESG shareholder proposals. Staff Legal Bulletin 14L states that the SEC will now focus on the social policy significance of issues raised by shareholder proposals, rather than an individual company's connection to a particular issue. How significant of a departure is this from the SEC's long-standing criteria that relied on a proposal having a connection to the company's ordinary business operations?
It is incredibly significant. As you pointed out, this is a huge shift in the approach to these topics. What we've actually seen in practice is that granted requests for no action relief post this rulemaking have fallen by about half. And what that means is that companies are now forced to deal with issues that are well outside of their control instead of being able to focus on things that are material to their underlying business.
So the impact is large, both on businesses and on the shareholders and the retail investor at the end of the day.
That is correct.
Mr. Nettram, it has been observed in the past that proxy firms ISS and Glass Lewis have released voting recommendations based on inaccurate and flawed data. I got incredible numbers yesterday. Somewhere around 42% of those are saying that this information is completely flawed and inaccurate. Investors who rely on the firm's recommendations are at risk of making uninformed decisions, undermining the integrity of the market. In this context, can companies review proxy firm recommendations and provide feedback to ensure that shareholders can make well-informed decisions when voting?
Currently, no. No such process exists for companies to make sure that the data that runs into the vote recommendations are accurate.
So why is it crucial for businesses to have the opportunity to review and offer feedback on draft proxy firm recommendations?
Well, because what we're talking about are effectively governance decisions on the direction of a business on which Main Street investors are relying for their retirement security. If those decisions are based on incomplete, inaccurate, or misleading data, well, the end result cannot be good.
And upwards of 42% is a very large amount. Would requiring proxy advisor firms to disclose their methodologies, calculations, and sources of information lead to a more transparent and reliable advisory process?
Absolutely.
Well, the chair now, I thank you, and I will yield back my time. And